Hey party people, welcome back to Wealth Insights Weekly. It is I, Rags to Riches, here with another update on the market, the economy, real estate, pretty much anything that is of my interest I will speak of on this show. Before we get into brass tacks, I do want to let you guys know a few disclaimers. First and foremost, this is not financial advice, as I cannot, will not, and do not want to be your financial advisor. I don't see you paying me fees, and accordingly none of this can be mispursued or misperceived as investment recommendations, solicitations to buy or sell any security. Secondarily, regardless of whatever I say in this video, please note that past performance does not equal future returns, and if you invest your capital, you as a retail investor are likely and very likely going to lose every single dollar. Now, with all that boring stuff out of the way, because I have to say it just to make sure that Uncle Sam doesn't call me a financial advisor under the books, I have some news for you guys today. So, just for some context on the goal of this show, a lot happens during the week. There aren't a lot of places that compiles information into a single source for for it to be at your fingertips. I want to spend at least 15 to 20 minutes each weekend going through what happened in the broader economy, stock market, housing market, anything else that is relevant as someone is constructing, building, and managing a portfolio, so that when we head into the next week, we have as much information as could be helpful to make our moves in the market. Now, this week was a very big week for economic releases. We had CPI come out, the FOMC meeting. We have some real estate trends that are pretty concerning as far as foreclosures and a slowing down of the residential real estate market. And maybe a good place for us to start, as always, is going to be with the broader economy. Coming in from Bloomberg, markets look for Powell to validate upbeat CPI data. A few bullet points from them. U.S. consumer inflation gauge comes in cooler than expected, easing price pressures, stroke bets on the Fed rate cuts, cheaper gasoline, car insurance, and other items ease inflationary burden. And then finally, shelter costs were the biggest component in May price indexes. So getting into the actual stats, it looked like CPI this week for the month of May compared to April was flat. This was the first time in almost 2 years that it didn't climb, and this is in part, as mentioned before, due to a drop in gasoline prices. When you're looking at core CPI, or the main basket of goods which are used to determine the index, this is going to exclude the volatile factors of food and energy. This rose about 0.2%, the least since October of this year. It actually undershot all but 12 of the 71 forecasts in Bloomberg's survey. And when you break down the CPI print a little bit further, it looks like services were the main reason why core inflation came in less than forecasted. This was helped by a decline in car insurance after the biggest run-up in prices in the category since in 1970. Airline fares were also down. I know there's some news right now about United Airlines and American Airlines having some trouble with getting their employees to show up to work, but I think this is a part of the reason why that is the case. The also so-called super score services gauge, which excludes housing, dropped by 0.04%, the first decline since 2021, and this bodes well for the Fed's preferred inflation gauge of PCE. Getting into the annual rate, this actually came down by 3.4%, the lowest since April of 2021, and this was aided by a small increase in housing costs in more than 2 years. Headline CPI came in at 3.3% as well. So, why is the CPI print relevant for investors of the stock, fixed income, or crypto markets? Simply put, the Fed is waiting patiently for their hiking cycle to slow down the economy, and one of the main components to their preferred measure of inflation, PCE, as mentioned in this article, is CPI. We want to see continued declining inflation via CPI and then by consequence PCE, as once we head close and back to a 2% annualized rate of growth for the CPI, then the Fed may be in a place where they can begin to cut interest rates in anticipation of further economic slowdown. In short, the more CPI prints we get at expectations, or even more so, preferably below expectations, that is going to be a leading indicator for when the Fed's going to cut. Stock prices are probably going to fall because they don't cut unless the economy is in a bad spot. But then by consequence, because fixed income prices are inversely correlated to that of yields or interest rates, when the Fed cuts, bond prices will go up, and that is one of the things that I actually mentioned in a few videos back. Be sure to click the link in the description if I can figure it out. Maybe there will be like a one of those YouTube things you can click on. It'll take you to my video presenting the case on fixed income. Now, heading into the next article, we did see from Barron's hiring surges more than expected. This is coming from the May employment report released on June 9th. Coming in from the Bureau of Labor Statistics, published the May employment report that morning. Employers added 272,000 non-farm payrolls in May versus 180,000 as a forecast, according to FactSet. Beating expectations for new jobs is a pretty good thing, especially if you want to see inflation cooling while maintaining a resilient labor market. I do believe the Fed wants unemployment to go up, but it does seem as though the economy is still plugging away. People are still employed. There were a few revisions that came out from the release as well. April hiring was revised down 165,000 from 175,000. The March hiring rate was lowered from 310,000 from 315,000. And as mentioned last week, the unemployment rate did tick up to 4% in May from a 3.9% in April. Now, this is something that isn't often talked about, but there is a measure called the labor force participation rate. In short, when you are looking at the broader economy, the unemployment rate is looking at everyone who is actively looking for work and cannot get a job, whereas the labor force participation rate is actually considering out of all Americans who could potentially be working, how many are actively in the workforce. And this figure is never going to be close to 100% because there are large swaths of the economy that have no reason to work. Perhaps you run a business that had a liquidity event, you sold it off, and you retired. Perhaps you saved up enough money and you could retire early. Perhaps you are a stay-at-home mother or father and there's no need for you to work, and accordingly then you're not going to be looking for work even though you are in a technical sense unemployed. I think it's a really important stat to keep a track of, though, because we want more people to be engaged in the economy. Not everyone needs to be a Jamie Dimon banker. Not everyone needs to be a Elon Musk-esque entrepreneur. Not everyone needs to be a mechanic, plumber, nurse, or whatever vocation that you choose to be in your day. But it goes to show that the economy is becoming increasingly tough for young people, specifically millennials, Generation Z, and then in the next few years, Generation Alpha, to get a new role. How many 18 to 25-year-olds do you know who are living at home, who can't get a job, that have massive student loans, and have some serious problems they got to deal with? I know plenty of them. I'm sure you do as well. And on that note, as we see employment continue to beat expectations, there is a risk that inflation could resurge itself. When people are employed, they have money to spend, and when they have money to spend, there's more dollars chasing the same amount of goods in the broader economy. But I wouldn't mind a continued strong labor market. The more people that are employed means the healthier economic growth is going to be moving forward. Now, getting into the FOMC, we did see the Fed leave rates unchanged, and they only see one cut in 2024 despite inflation progress. That CPI print that I had mentioned earlier. Coming in from Reuters on June 12th, U.S. central banks leave policy rate at 5.25% to 5.5% range, unchanged from the previous meetings. Fed policymakers also scaled back their expectation for cuts to one cut in 2024, and policy easing hinges on more progress in reducing inflation. I actually spent a good portion of this morning after going to the gym listening to the FOMC press conference because, god dang it, I was very busy this past week. I had no time to watch live. And essentially he's saying we need to remain dependent on the data. We need inflation to continue to cool down. The housing market is fine, but we will eventually have to cut if things don't continue to move. In short, it looks like the Fed is comfortable but not necessarily pleased enough to begin to cut rates because of their commentary around the economy and the fact that they left interest rates unchanged. I remember at the start of the year there was a broader notion of 6 to 12 rate cuts, each 25 basis points from some pretty large institutions like Goldman Sachs, Morgan Stanley, JP Morgan types of banks. And they were completely wrong because inflation has not gone away. We saw a very sticky period of inflation during the first quarter of this year. And while on the longer term trends, we are heading back to what the Fed wants us to be at, about a 2% annualized inflation rate, we're certainly not there yet, and the Fed cannot cut. Now, this doesn't say that the Fed can't pivot in the event that something bad happens in the economy. If we see major banking failures, if we see a breakdown in the employment market, hence the 4% unemployment rate that continues to increase day by day, then the Fed may have to cut to save the labor market. However, until we see true weakness, some kind of systemic event in the labor market, inflation is still too high for Jerome Powell and his buddies at the FOMC to cut, and accordingly for this meeting, they kept things unchanged. One thing you got to keep in mind with the Fed, guys, is that they aren't necessarily in the game of being transparent and giving out good information. They use these policy meetings, their statements, their summary economic projections, etc., to present the narrative, to put a seed in the minds of Americans and market participants about what they want people to think the Fed is going to do. Meaning, the Fed's not going to tell you their actual thoughts on inflation. They're trying to shape, to direct your thoughts and ultimately your behaviors through their policy statements and their decisions. I don't leave a lot of precedence on the Fed. Jerome Powell could wear a purple tie, blue tie, red tie. Stocks could go up, down, sideways. No one knows what's going to happen. Neither does Jerome Powell. The only thing they can do is raise or cut interest rates, and then on occasion use quantitative or monetary policy to increase or decrease the money supply. And all these things happen on a lag in a multifaceted, extremely complicated system. While we can perhaps model out the impact of a Fed hike or Fed cut, at the end of the day, no one knows how it's going to trickle through the broader economy. But you know who does have some opinions about the economy? Our friend Janet Yellen from the U.S. Treasury. She believes, and this is coming in from Reuters on the 13th of June, the U.S. needs public-private investments and our subsidies to China are excessive. I actually, for the first time in a little bit, I agree with her, but getting into the article a bit further, U.S. Secretary Janet Yellen said on Thursday that U.S. public investments that attract private capital are crucial for promoting sustainable and inclusive growth over the long term, and she also warned that China's model of massive state industrial subsidies were unacceptable to the world. This is coming in from her remarks at the Economic Club in New York, that traditional supply-side economics that rely too heavily on tax cut to spur investments and has failed to benefit enough workers. And I think there is some truth to this. When you just cut interest rates, when you just cut taxes for large corporates, they may be able to take on additional debt or increase their profit margins, but at the end of the day, a business owner's incentive is not to pay its employees more. Their incentive is their bottom line to their shareholders, and if it's not a publicly traded company, the shareholders are really the executives and the CEO. So I think there is some truth that lowering taxes for corporations doesn't necessarily imply that Americans are going to be doing well from it. But on a broader perspective, if we are going to be taxing individuals, corporations for the purpose of economic stability and enhancement of the broader American people, we actually need to have a well thought out, nuanced, and defined plan for what those proceeds from the taxes are going to be doing. And I think it's pretty clear to say U.S. politicians are not the best at having an economic plan to make everything better. They just kind of burn through money. But at least on this note, I kind of agree with Janet Yellen on this article. Now, the World Bank does believe global growth is continuing. Coming in from AP News, World Bank boosts forecast strength of U.S. economy will support global growth of 2.6% this year. A little bit above the Fed's expectations for inflation, but more growth is not necessarily a bad thing if you can actually be actively invested in the markets to capitalize it. Getting into some of the details, the World Bank upgraded its outlook for the global economy on Tuesday, estimating that it will expand 2.6% this year on strength of sustained growth. The bank's outlook marks an increase from 2.4% for 2024 as predicted in January, and it would match the global's economy 2.6% in expansion in 2023. The one thing to keep in mind, though, and this is also mentioned in the article, is that they caution that global growth remains sluggish by past standards, that the poorest countries are struggling under the weights of heavy debts and high interest rates, and the increased trade barriers endanger prosperity worldwide. You think about wars in the Ukraine and Gaza also inflicting pressure on regional economies. And is the U.S. economy truly in a strong spot, or are we just seeing a representation of a few large corporations making use of very powerful new technologies, i.e., the chat GPTs, the large language models of the world, renewable energies for some energy companies, uranium for data centers that need power that can't be supported by current grid loads, things along those lines. When you actually break out the S&P 500 to its individual components, you see that a large concentration of the returns in the past few years are coming from an increasingly tiny pool of the market. Think Nvidia, think Apple, think Google, think Amazon, think Tesla, think the Magnificent Seven, if that's what they want to call it that. But history, generally speaking, repeats itself, and we've seen market environments in 2001, 2008, the 1980s, etc., where we've had large concentrations of a few stocks driving the returns and making up the larger baskets of the market, S&P 500 and NASDAQ, that eventually their longer-term cyclical trends slow down and they take down the market. I'm not trying to say that a few companies doing well is a representation that the world's going to fall apart, but what I am saying is that I think the World Bank is kind of hitting the nail on the head. The U.S. is in a strong fiscal position because we hiked interest rates and we're the global reserve currency. Other countries which have a weaker currency compared to the dollar and have less ability to maneuver around the monetary policy that our Federal Reserve and Treasury conducts are going to continue to suffer. And then you add on the additional impacts of regional conflict, supply chain disruptions, and things along those lines, and it makes sense that global growth is going to do better than expected despite all the rate hikes that we've seen across the world. But it's not as though we're in good, healthy economic times. The world is slowing, and this is a reflection of that as well. Now, getting into some specifics here, looks like stock index futures slip after hitting new records. U.S. economic data is on tap. This is coming in from Bar Chart on June 14th. They mentioned that the June S&P 500 E-mini futures are down 52 bips, and the June NASDAQ E-mini futures are down 29 bips this morning after the benchmark S&P and tech-heavy NASDAQ posted their fourth straight record closes from the previous sessions, with investors at the University of Michigan survey consumer confidence for clues on the economy. We went over a lot of the economic data that we saw here, but the stock market continues to reach new all-time highs day after day, week after week, with the expectation that there's going to be continued sustained economic growth. I don't necessarily buy into this thesis on the medium term. If the Fed is gearing up to cut interest rates, they're going to only do so if and when something is wrong with the fundamental economy. Consumers are carrying more debt than they historically ever have. The U.S. government is carrying more debt than it ever has in history. Interest rates are elevated, and at some point this will trickle through to impact and slow the economy. Whether we get a hard landing, a soft landing, is really not the question. It's more of a matter of when instead of if. But historically speaking, the equity markets are the last to smell the roses, to see the bigger issues that are going on, and this is reflecting in recent price action that we've seen in the equity markets. Now, this isn't to say that you shouldn't own stocks. When you look at the longer-term historical returns of the S&P 500, you're looking at 7 to 10% if dividends are reinvested annually. And that doesn't mean that each year your portfolio is going to go up 7 to 10%. Some years it may be 15, some years it may be 30, some years you may go down by 50%. But when you broaden out the spectrum of your investable time horizon, you are likely to make money in the U.S. and debatably global stock markets. However, that doesn't necessarily mean that every period of time is going to be a good period of time, and I'm on the camp that I do think we are going to see a correction, maybe not necessarily a crash, pending confirmation from further economic releases. I think back to the March banking crisis of, I believe it was 2023, when we saw Silicon Valley Bank and First Republic Bank fall. That happened in a period of literal weeks, out of nowhere, and systemic events that are black swan in nature aren't going to be widely advertised. It's going to be something that after the fact you realize was a pretty big deal, and in the moment it kind of cascaded upon itself. And as mentioned earlier by me, coming in from Market Watch, big tech, not the Fed, is driving the U.S. stock market rally, and some things that investors need to know are going to be the following. There actually isn't much that they want to say. But, I want to double click on this item as well. You got companies like Apple, Microsoft, Nvidia, etc. that are continuing to pump, go up. Big tech is what is driving the broader economic market rally that we're seeing today. It's not your standard small cap, mid cap company. There's extreme dispersion in the equity markets today. And as an active investor, if you have a process and an ability to actually select securities that are going to give you alpha for your portfolio, when you have broad dispersion in the markets, this is actually a time where you can either buy extremely undervalued companies that are being overlooked by the market, or use the dislocations and prices that you see on an aggregate perspective to make alpha for your portfolio. Now, one more article for the evening here on the stock market. We do have CEOs at Trump's meeting last week. Supposedly, the ex-president is meandering and doesn't know what he's talking about. Some key points include the former president failed to impress everyone in a room of top CEOs this week. Multiple attendees told CNBC. Some of the CEOs actually believe that Trump doesn't even know what he's talking about, and several CEOs said that Trump was remarkably meandering, could not keep a straightforward thought, and was all over the map. And this is coming in from, I think a portion of the population that is not the biggest fan of Donald Trump. As we head into the November election, we are going to see increasingly strong rhetoric come out from the Democrats, Republicans, and corporate sectors about who they think would be best for the broader economy. I don't necessarily have a view or a bias about whether it'd be better if Democrats or Republicans are in office on the executive level. All I really care about as an investor is that we don't have a unified House, Senate, and president as far as the political party goes. The more gridlock there can be, the more certainty the market's going to have about what the rules of the game are. There aren't going to be major, wide, sweeping legislations that are passed if only one person, if multiple parties actually hold office. The more gridlocked we can see the U.S. economy, the better it is for the markets because they have certainty about what is going to be the case. And I think articles like this are just going to be increasingly common as we head into the summer and then especially into the fall, as we eventually get to the point where the election's truly in full steam. People need to make a decision about who they want to vote into office for the president, and then by consequence, all the cockroaches are going to come out the walls and make their claims about who they think is the best and why they think they're the best and who shouldn't be the president of the United States. But if we take this article at face value, it looks like Mr. former President Trump did not do too well in his meeting. Now, I want to briefly touch on the housing market. One of the things that I particularly focus on since the Fed's been cutting rates is U.S. real estate. U.S. real estate makes an extremely large portion of the U.S. economy, and if you're looking for a leading indicator about where GDP is going to go, look at the mortgage market, look at residential real estate financing. Typically, for the average American, their home is going to be their single largest investment, followed by their retirement account, and then followed by their savings account. And with rates being increased as much as they are, at a broad perspective, individuals can't move. Let me give you a real-life example here. Let's say you bought a $500,000 house during the pandemic at a 3% interest rate. You had 2 kids, and now you need to move to buy a larger house because they need somewhere to sleep and you need a backyard and maybe got a new job, etc. For you to buy that same $500,000 house today with current market interest rates, your payment is going to be substantially higher. So for individuals that have either refinanced or bought a house during the pandemic and when the Fed cut rates, they can't get into the new homes without having to downsize, and people don't downsize with real estate. And inversely, you have a broad swath of first-time home buyers that can't get into the market because of where current rates are. And getting into this article from the Fast Company, who is buying real estate today? Well, generally speaking, it's all cash buyers in the luxury real estate market because they actually have the wherewithal to purchase homes without getting a mortgage. They can circumvent that process. There's actually a really interesting strategy called tax-aware borrowing for anyone that bought a home in cash. I probably should make an article about that another day, but there is something on my website that goes through it. Now, this article is basically saying the amount of homeowners that are occupied without a mortgage has increasingly rose since 2010. As of 2022 is at 38.5%. Essentially, 4 out of every 10 Americans that own a home do not have a mortgage. And there is an argument to be made that a large portion of these individuals are the baby boomers and investors that are doing real estate financing for, building up like a passive real estate income portfolio. But there is a large portion of the supply of the market that cannot be gotten rid of, because for these homeowners, if they did want to move or to downsize or to get some other type of property, they're going to have to, 1, get a mortgage, 2, at a high rate, 3, at elevated housing prices, and then 4, they're going to have to downsize. And as mentioned before, people do not like to downsize their housing markets, or their housing prices. As you can see, I have a message, so I'm going to have to deal with that later. Because, I'm out here just trying to get these hoes. Just bear with me as I put this on Do Not Disturb, as I do not have time for that. Few more articles here, guys. We got the NHAB Builders Report. 22% all cash sales in 2024. Just additional supporting evidence in my previous argument there. And now getting into the brass tacks, what's going on with the housing market? Well, no one is buying houses right now. Existing home sales are back to 1978 levels. And while home prices have remained stable because no one is selling because they don't want to downside, existing home sales is essentially at a free fall. There are no homes being sold right now. The places where we're seeing homes be sold are the new construction market. Why is that? Because developers need to offload those units to recoup the cost of their investment, the new building. What can they do to incentivize someone to buy? They can offer discounts, points, teasers, amenities, things that first-time homebuyers who want to get into a condo or a single-family home in a collection, community, etc., wouldn't be able to get from a traditional existing home seller. Mom and pop living in their single family home trying to go to a retirement house can't give you a mortgage point buy down, and they certainly don't have the cash to do so, whereas a developer can. Now, we do see foreclosures ticking up slightly in the U.S. housing market. Coming in from MyChesco, U.S. foreclosures increased slightly, reflecting nuanced housing market shifts. Released in May 2024 data, the Foreclosure Market Report, it revealed that 32,621 properties are going to be filing for foreclosure in May. These include default notices, scheduled auctions, and bank repossessions. This marks a 3% increase from the previous month, but a 7% decrease from the previous year. Now, I think foreclosures are something that we should pay attention to, but there is such a robust and nuanced loss mitigation market out there. Fun fact about me, one of my first jobs was actually in a loss mitigation department team for a regional bank. Spent the first 2 years of my career basically on the phone, getting people into modifications, walking them through the process and underwriting it. Essentially, if you get foreclosed on, you made every single effort not to work with your lender. They have programs to repay your debt. They have programs to modify your debt. They have programs to modify your debt and defer your debt at the same time with the balloon payment, which you can then refinance at some point later down the line. And for people that are getting foreclosed on, it's truly because they don't have a job. Provided that you make some type of income similar to what you had made at the time of origination, there is a way to restructure the loan, and this all comes out of the Dodd-Frank Act of 2009 from the housing market crash to get you to remain in your home. But on that note, one thing I do want to mention as a closing thought on the luxury housing market is that luxury homes in certain places are falling off a cliff. Look at Dana Point, California, Long Island, New York, Massachusetts, Nantucket, Miami, Fort Lauderdale, San Diego, where there is the risk of flood. People are not able to sell their homes at the prices they thought they would. Just an example here from the article, a Nantucket home listed last summer just over $2 million, sold earlier this year for just $600,000. And why is that? There is a real issue in America today about homeowners insurance, especially for wind and flood zones. Insurance companies, due to arguably years, if not decades, of malpractice from the insurance industry, have systematically raised premiums. And why is that? Because people just continue to claim when there isn't actually something going wrong with the house. The insurance companies, trying to offset some of these losses that they've accrued over the past years, have rapidly increased premiums to the point where it's essentially unaffordable to even own the home. Maybe you can afford the principal, interest, and tax payment of the subject property, but if insurance is going to make up 3/4 of your monthly payment, people aren't going to be getting into houses. This is especially impacting the luxury real estate market, and some lenders are actually looking to self-insurance programs to mitigate around that. But we are seeing some dislocations in the luxury housing market, which has remained resilient since the start of 2022, at least on an average price level, and I do expect to see more situations like this moving forward. So guys, we went through a lot. I didn't realize I was going to be talking with you guys for a half hour today, but I hope you found some information that was interesting. As a closing thought, and in short summary, we have cooling inflation and FOMC that is trying to remain data dependent. We have a stock market that's increasingly concentrated within a few select names, driving up values. But on that same note, there is broad dispersion in the securities market. If you are an active investor with an ability to use a top-down and then bottoms-up fundamental analysis to buy and sell stocks, you can likely produce alpha. And this is the first time where beta, meaning the correlation to the broader market, is not actually going to be the determining factor for someone's portfolio returns. This is a stock market. This is a fixed income market. This is an economy today where active management could lead to outperformance. And for someone with the ability to pick stocks, now's a really good time to do so. Real estate remains resilient, but we are seeing some pockets of dislocation in the luxury market, and candidly in transaction volumes. We are essentially in a housing market great depression as far as loan originations go, and I don't expect that to change until the Fed has a chance to cut. If you guys like this video, be sure to like, subscribe, and share with your friends. Wealth Insights Weekly is a service by me for you, so we can just chit chat about the market. I think I've mentioned this in the past few videos, but I would love to have somebody on the show to chit chat about the markets, share our perspectives, and then of course longer term to turn our rags into riches. I hope you all have a great week coming up. Be sure to do something that invigorates you and brings you happiness and joy, and I will talk with you all soon. Bye now.